Hey everyone, and welcome to this explainer on DBS Group's Q1 2026 financial results. Look, if you're a focused dividend growth investor, you already know the banking landscape is going through some major shifts right now. But what we're looking at today is, honestly, what can only be described as a masterclass in banking resilience. So let's just dive right in and decode exactly how DBS is securing its massive payouts in a pretty turbulent world.
Here is a quick roadmap of what we're going to cover. We'll start with how they're navigating the new normal, dig into that massive $2.3 billion dividend, look at wealth management, break down how they're handling the NIM squeeze, check out their Iran war stress tests, and then wrap it all up with the long game. All right, kicking things off with Section 1, navigating the new normal, and hitting some record highs along the way. Let's be real, banking in 2026 is no walk in the park. You've got elevated interest rates and some serious geopolitical tension out there. But even against that intense backdrop, CEO Tan Su-shan pointed out a phenomenal first-quarter net profit of 2.93 billion Singapore dollars. But for us dividend investors, the truly impressive metric here, it's that 17% return on equity. Pulling off a 17% ROE in this kind of challenging macro environment just proves that their underlying capital allocation is incredibly efficient. Moving right along to Section 2. The $2.3 billion dividend. Now, this is a massive statement. Let's get to the primary focus for most of you watching today, the immediate shareholder reward. They announced 81 cents per share for the Q1 total dividend. And when you stop and think about the sheer scale of what that number actually represents, it's pretty staggering. Across all their outstanding shares, that 81 cents translates to a massive, sustainable payout of $2.302 billion. And remember, that's just for one single quarter. Let's actually break down exactly how investors are getting paid out here. That 81-cent payout is split into two distinct buckets. First, you've got your ordinary dividend of 66 cents, which comes from standard operating earnings. But then, on top of that, management layered in a one-tier tax-exempt capital return dividend of 15 cents. So what we're seeing is a very deliberate, calculated strategy of returning excess capital directly into your pockets. Okay, Section 3, wealth management. This is really becoming their new growth engine. So you might be wondering, how exactly are they funding these massive dividends? Well, we're looking at a 12% quarter-on-quarter rise in income, which pushed their total income to a record $5.95 billion. But here's the interesting part. It wasn't just driven by standard lending. This jump was heavily fueled by record fee income, specifically from wealth management, and a massive surge in treasury customer sales. In fact, their markets trading income literally more than doubled. And the thing is, they are actively scaling this wealth franchise right now. They aren't just sitting comfortably in traditional offshore hubs like Singapore and Hong Kong anymore. DBS is going after massive onshore wealth creation by physically expanding their wealth centers in high-growth Asian markets. We're talking Taiwan, China, Indonesia, and India. Take Taiwan, for example. The spillover from the semiconductor supply chains there is creating a vast amount of new wealth across mid-caps and SMEs. DBS is strategically positioning itself right in the middle of that to capture those flows. Now for Section 4, managing the NIM squeeze through strategic hedging. Because look, making money is only half the battle, right? Defending it is the other half. And we do have to acknowledge the very real interest rate headwinds facing the banking sector today. Year over year, DBS did face a 23 basis point drop in their net interest margin, or NIM, mainly due to lower interest rates and a stronger Singapore dollar. But look at how they mitigated it. Management maintained roughly $210 billion in fixed-rate assets and utilized some very strategic hedging. They essentially built a financial fortress wall that completely neutralized that severe rate pressure. On top of that, management is being incredibly transparent and, honestly, quite conservative. They've revised their outlook to assume a 1% SORA, that's the Singapore overnight rate average, which is down from their previous assumption of 1.25%. What they are explicitly telling us here is that they are not counting on US Fed rate cuts to bail them out. They are fully preparing their books for prolonged high rates and macro uncertainty. And what that means for you is that any positive rate shifts from here on out, that just becomes pure upside for the bank. Which brings us to Section 5. Stress testing the Iran war impact and assessing global risks. We absolutely have to address the elephant in the room for cautious investors, which is geopolitical risk and how it might threaten the stability of that 81-cent dividend. Let's look at exactly what CEO Tan Su-shan said. Our direct Middle East exposure is limited. The second-order impact, inflation, supply disruptions, is what we are more focused on. This should be a big reassurance for investors. The direct credit risk to borrowers in the conflict zone is low. Instead, what the bank is doing is actively running stress tests on global supply chain breakages, higher freight costs, and energy pipeline disruptions, just to ensure their large corporate clients can actually weather the storm.
But here's the kicker. DBS didn't just sit around running theoretical models. They actually took action. A full year ago, anticipating this kind of economic volatility, they proactively de-risked their vulnerable SME and unsecured consumer portfolios in key markets like India, Indonesia, and to some extent China. And that kind of proactive, forward-thinking maneuvering, that is exactly why their balance sheet remains in such a phenomenal place today, with non-performing loans holding perfectly stable at just 1.0%.
Finally, Section 6, the forward-looking summary, or basically how to invest in the long game.
Let's bring this whole explainer home by tying these Q1 data points directly back to your long-term dividend growth thesis. The bank's 2026 outlook is firm. Despite all the headwinds we talked about, DBS expects to maintain total income at around 2025 levels. They are aggressively expanding those recurring fee corridors, especially in wealth and institutional banking, and they are rigorously protecting that fortress balance sheet. The foundation for continued, steady growth is well and truly in place here.
So understanding their playbook is absolutely crucial. Here are the concrete strategic steps DBS is executing right now. First, they are capturing strong deposit growth and deploying those excess deposits directly into high-quality liquid assets, which gives them high returns with low risk. Second, they are actively hunting structural growth, specifically in wealth management and the tech, media, and telecom sectors. And third, they're maintaining incredibly strict cost discipline, targeting a low 40% cost-income ratio. Guys, this is exactly how you sustain a multi-billion-dollar payout.
Which leaves us with this final thought. You've seen their defensive risk management. You've seen the aggressive onshore wealth expansion. So, with a literal fortress of a balance sheet, a 17% return on equity, and a management team that proactively stress tests against global conflicts, how does a resilient yield engine like DBS fit into your dividend portfolio's long game? Think about it. Thanks so much for joining me for this explainer, and keep building that wealth.